Hi there, let's take a look at another source of finance. This is often used for new businesses. This one is owner's capital. Well, once again, there's a clue in the term, isn't it? Owner's capital, capital or finance put into the business by the business owner. And it's often also the business founder, the person who starts the business, and he or she puts assets such as maybe a large redundancy payment that he or she has had as a consequence of leaving a job, perhaps some money they've come into as a consequence of inheritance, perhaps an older entrepreneur using a pension lump sum, or even using personal credit cards. Not always a good idea, but a means of providing finance to enable the business to establish itself. So that's what we mean by owner's capital, capital provided by the owner directly into the business to provide finance for the business. And you can see from those examples I've used there that there are some potential advantages for using owner's capital. Firstly, and perhaps most importantly, there's no impact on ownership, is there? If the owner is providing capital, it's not about selling shares to somebody else. You keep 100% of the business, and unless you decide to pay yourself some interest, there's no interest for the business to pay. Owner's capital has a great benefit in terms of its speed. You, the owner, decide how and when you put capital into the business if you've got access to it. So it's quick, it's easy, it's flexible. You decide how much, how often, and of course, one of the benefits of that is that you can do it in small amounts. Perhaps, for example, in a small business, just putting owner's capital into the business each month or each week to pay the wages or the salaries of the employees whilst the business is established. So a very flexible and a very commonly used method of finance, particularly, as I say, for startup or small businesses. Well, what are the downsides? Well, it's all about risk, isn't it? It's about risk that you could lose that capital. You could lose that inheritance, that pension payment, that redundancy payment if the business fails, particularly if you have unlimited liability. There's also a downside, which is what we might call an opportunity cost, which is the alternative return that you could have had by investing that capital in something else other than the business. For example, by investing it in a savings account, even though these days interest rates on savings accounts are very low. Therefore, you might say the opportunity cost is therefore low. But there are one or two other things to consider. Firstly, if you're using the family's money, a redundancy payment, an inheritance, and you're using it to provide finance for your business idea, what happens if the business idea fails? Are there risks that could put a strain on the relationships that you have with family as a consequence of using up the family capital for your business idea? And we mentioned credit cards just earlier on there. A lot of business owners, particularly at the startup stage, do use their personal credit card to incur costs for the business. And if they're not careful, they end up using more and more and taking out more credit card balances. And there's a danger that the owner becomes highly indebted to the credit card companies as a consequence of using that means of finance to provide capital, owner's capital, into the business. So it's a dangerous game, that one. Anyway, there we go. Hopefully that's useful. That's just an overview there of one of the potential sources of finance, which is owner's capital.